Hello again, everyone. Welcome back to the Daily Gold podcast. This is being recorded on the afternoon of the end of the month, Saturday, August 31st, 2024. Thank you so much for tuning in. And with me today, we do this at the end of every month, is Vince Lanci. You know him from Gold Fix. He's also an adjunct professor at the University of Connecticut. And Vince, okay, very interesting point in the market. Gold was up last month, over $50 the futures, but you look at silver, you look at the gold stocks, GDX, GDXJ. I mean, basically around unchanged, nothing much to write home about. So that's, even though I like the setup of gold stocks, I know we're going to get into that later. You do have silver underperforming gold. You do have the gold stocks at significant resistance. So these are the things that are in my head as far as the technicals in the intermarket analysis. What say you on those fronts?
Um, well, just speaking out of my depth, but just speaking to to your um to your focus. Technically, I don't see what makes gold look bad. Silver, on the other hand, I don't think it looks bad either. I just think it looks range bound. The mining index stocks, what have you, I don't have a lot of focus on them. I had a mining position for a while, for about 6 months, but I got out of it. And so now, uh, speaking purely technically, uh, as an amateur, it looks good. Gold looks good. And I'm not worried about silver being a weight on gold on a day-to-day basis because I know that silver is being used to accumulate gold. And we're going to touch on this when we get into the whole market bearish, market bullish stuff from the flows that I see. But they recently, I'm just throwing this in there. I know we didn't discuss this, but I'm just throwing this in there. Last week, the Comex raised margins in gold and lowered margins in silver. Bob uh, Bob Coleman mentioned that, and that's very rare. And when it happens, it's a sign of something. Now, I have my own opinion of what it's a sign of, but it's not a sign of bullishness. It is a sign of people worried about the market going up too much, and they're going to start putting a lid on it. So it's a sign of bears taking action to defend their position. So technically, it looks good, but the flows that I'm seeing and that news out of Comex makes me a little concerned that they're getting serious about, quote, tamping it down, if you know what I mean.
Right. And have can you recall a time when they actually lowered margins for silver but raised them for gold? I mean, I don't follow that stuff as anywhere to as close as you do, but I don't remember that ever happening.
Uh, I've never seen it happen. Um, but through the years, like we're talking almost 30 years of paying attention to those things, having been educated to pay attention to them, when they raise margins, it's to slow down a market. When they lower margins, it's to encourage a market. So historically, you raise margins when you think a market's getting too out of control. That happens to be on the COMEX when metals are on the highs. It's never when metals are on the lows. I mean, that's the bias of the market structure. In silver, you'll see them raise silver margins when silver's running and gold's not, but they won't lower gold margins. So to comment on what you said, I have never seen them raise gold margins and lower silver margins simultaneously, almost like, not almost, they're related to each other. And they're conveying a message to the marketplace in general. And that message is ostensibly, let's say you're a mainstream media person who actually thinks of these things. It means gold's getting too frothy, so we're going to raise margins, and silver's not performing like it's a precious metal enough. For gold to be this high, silver should be higher. Now, it's a complete contradiction in your stated mission to say I'm raising gold margins because I want gold to settle down a little bit, but I'm lowering silver margins because I want to encourage another bubble. I mean, it makes no sense at all. Now, it makes sense in their world, but it does make sense in a different world. And so I'm going to get into that. For the last 6 months, even the last year, the gold and silver prices have diverged intraday, over the month. And you've had some big, big, big silver knee jerk reactions, like in April and May when it caught up. But generally speaking, since 2022, after the silver squeeze was squashed or aborted, silver has lacked gold. And that's a very simple fundamental reason for that, which you probably see in technicals. And that is central banks are not buying silver, they're buying gold. And so if they're buying gold and they're not buying silver, well, then gold's going to go up, number one. Number two, the technical funds, people who think such as yourself, and people who think like me, I think like, oh, the central banks are buying it, I'm going to buy it too. It's kind of like a flow trade or front running, if you want to be crass about it. Technical guys like yourself are like, oh, look, cup and handle broken out, buy it. These things happen because central banks, BRICS, and the West are just buying it hand over fist. And that's why in March, when things started to really clip, gold pulled away in March and started to really rally. And then silver caught up after a while. Anyway, the point is, gold has outperformed silver for a reason. Now, you may say that's not a valid reason in the big picture because they're both precious metals. But as far as central banks are concerned, they don't give a damn about silver. They only care about gold. Now, that's a mistake. I'm not saying central banks should be buying silver. I am saying that sovereign wealth funds and nations are buying silver. It's just not showing up on the radar yet. India is buying silver hand over fist. China is buying silver hand over fist. There's actual real silver above ground shortages that are manifesting, but you can get away with rehypothecating silver because central banks aren't buying it. Central banks take delivery. So silver has been lackluster, which brings us to the margin change. The margin change is a thing of beauty. This is my opinion, right? Knowing that the gold silver ratio trades the way it does, because there are people out there who are buying gold and selling silver, literally, for various reasons. The Comex raising gold margins is to get people to stop buying gold. The Comex lowering silver margins is to get people to buy silver. When you put those two things together, in my opinion, that's a short position in gold crying uncle saying to the Comex, listen, these people want to stay long precious metals. Tell them that silver is a better buy. It's cheaper. It's got a lower margin. We need them to stop buying gold. There is a cry uncle thing going on here. And I believe it's at the bullion bank level, although I can't prove it. And I don't want to come across as some, sensational, YouTube clickbait artist, but there's panic is happening. There's a slow panic beneath the surface. And they're starting to pull out all the stops to get people to stop buying gold, which, by the way, could lead to a big spike next week. It really could. I mean, I'm not bullish right now, but I would be not surprised if raising margins caused gold to go higher next week for the first day or two. So that's the gold silver play. The gold silver play is this. Oh my goodness, there are too many people buying gold. Can we at least tell them to buy silver? Look, you walk into a car dealership and you say, I want the Cadillac. And they say, we're out of Cadillac. Can I interest you in a Buick? Now, I'm a silver person. Don't be offended, all you silver people out there. What they're trying to do is they're trying to substitute it, right? Silver should go for different reasons. But they're trying to say, silver, it's also shiny. It's also precious. Would you buy some of it? And the funds are saying, what, are you kidding me? The central banks are buying gold. I'm not buying silver. Meanwhile, they should be buying silver, but not as an alternative to gold, as something completely different. So that's my take on the margin raising and changes.
Yeah, just one thing I want to add. Um, I mean, you look at precious metals, yeah, silver's gone up, it's done well, the gold stocks have gone up. But I think part of the reason why gold hasn't ignited and why silver hasn't outperformed gold is because you still have the stock market outperforming gold. Like that, we have not, and
Ugh.
thinking about gold against the 60/40. And so gold has not broken out against the 60/40 or the stock market because when that happens, more capital is going to come in because I talked to someone, I mean, the KE report, because they mentioned to me, I think like a week or 2 weeks ago, the generalists they were talking to, then they were interviewing, they were like, they were still happy with stocks and yeah, they were trading or investing in gold,
Yeah.
but that's it. They don't care about silver. They don't care about the gold stocks. And so for me, that's putting a limit on potential capital that can come into the market and really, support and sustain a really strong move. Maybe that's why gold has not really been able to ignite, I think, to use your word, because I'm looking at the chart and it kind of had this rough bull flag. I think we talked about it. It broke out above 2,400. Then we had the sharp pullback, I think last month. And it's been grinding higher, but it just doesn't look impulsive at this point, which is what you would expect, if gold had truly broken out of a bull flag. And I mean impulsive because if you look at from February to April, like that's an impulsive move from 2000 to 2400. That was impulsive.
Yep.
Uh,
Yep.
but since then, gold has kind of been a little choppy. Yeah, it's trended higher. Still looks great on the quarterly, great on the monthly. But yeah, I mean, it just so that's kind of more of my thoughts on silver
Well,
underperforming and the technical action.
your comment about the 60/40 portfolio is relevant. I mean, it's always relevant. But I want to just add something to that because it's actually right. In America, in the United States, there are no Western retail people buying gold. What I mean, no, I mean almost no. Why? Because stocks are doing fine. American investors buy gold out of fear. And as long as stocks are going up, the public won't buy it. Now, they may buy it if they will buy it. Let's be clear. They will buy it if the Fed eases, but they're going to buy stocks more, right? And so when you make the statement that there's no impulsive behavior in gold, I agree because there's no fear. Now, should there be fear? I mean, the Middle East is going to zero, right? We're going to be invading Brazil in a week. The UK is, being taken over by immigrants. Uh, Russia is, in Ukraine. China is now facing off in the Philippines or in the Taiwan area. There should be fear. It seems like, and this is to give you frequently talk about the analog between the 70s and now, and that's a good analog. Here's what's different about then and now. Then they weren't smart enough to keep stocks up. Now they are. And so there won't be I mean, I'm saying there won't be, but until stocks crap out, there won't be the gold panic. There won't, because the public, which are millions and millions of investors who have trillions of dollars in 401ks, must be protected. So oil was over $100, stocks went up. Gold's over 2,500, stocks went up. The Middle East is a shit show, stocks went up. Like, if there's anything manipulated on this earth, the bond market down 30%, I'm sorry, like 20% in the last year, stocks went up.
Yeah.
Well, what happened to the whole, well, interest rates are higher, and if interest rates are higher, then we should be buyers of bonds, or at least take our money out of stocks and put it into cash? Nope, they're not doing that. Banks are going under. Buy stocks. I mean, it's cooked. And I'm not even crying about it. It's cooked. I'm long stocks. It's cooked. So you become the hero. I'm sure you're a hero anyway, but you become the real hero when the 60/40 portfolio breaks out versus the gold breakout versus
When
that.
gold breaks
And
out,
then
yeah.
we start, right? What?
When gold breaks out against the 60
When gold
40
breaks out relative
portfolio.
to 60/40 or some other similar indicator. And that's basically when the stock market goes down and they let it go down. Then you're going to see gold go up. And, what makes that happen? Well, a crisis that they're not ready for. COVID 2.0. Stocks go down, gold goes up, stocks don't go up. Here's one for you. The Fed says we changed our mind, we're not going to ease. Stocks go down a lot, but so does gold, because there's money in gold right now that's driven by potential Fed cut. So to boil it down, there is no fear money in gold right now. It's central banks that are buying gold as a replacement for treasuries. Gold's up 30%, bonds are down 30%. Well, there you have it. That's what's going on in the world. That's not fear. That's a replacement of a tier one asset with another tier one asset, right? And the war and all these other things, yeah, October 7th, Israel, Hamas invades Israel, Israel counter invades, and that makes gold go up, and it never gives it back, right? Never gives it back, October 7th, right? And then December 3rd, December 4th, that day comes along, and you have all these events that are making gold raise its plateau. But to your point, it's not getting overheated. Now, I believe it's not getting overheated, and I've said this to subscribers, it's not getting overheated because it's capped. And it's capped historically at 2%. It's capped for another reason. Any market that gets overheated is capped. 30-minute delay in trading, delayed opening, raising margin requirements, Robinhood, your platform doesn't work, or even Schwab had that. Those are all ways that they shut down the market and throttle demand while they figure out the problem. The problem is they need someone to sell it. Every time the gold market stops, someone is capping it, someone bigger than the bullion banks. And I believe, and have evidence to that effect, but nothing that would stand up in a court of law, that the Bank of International Settlements, which is the big daddy of backstops, is backstopping the bullion banks right now. The bullion banks are essentially acting as, what's the word? Instead of being principal traders, they're acting as agency traders for the BIS. And if you're not those not familiar with the BIS is every central bank in the G7 and outside the G7 has influence on the BIS. So if the American bullion banks are having a problem and the Fed says, we got to help these guys out a little bit, too big to fail, there's your effect. So the gold market has been capped at levels, various levels, December 3rd and 4th. And then it reignited on February 28th, right? Then it was capped April 12th. And it stayed capped until
in June or
July 11th. And then it got capped again, right? It got capped again on August 2nd. And then it got capped again. It's not obvious, but this is a cap, right? On August 20th, gold made a new high, and it hasn't made it since. No follow through. And that's when this whole sideways action restarted. And I'm saying, I believe firmly that this market is not being prohibited from going up. It's being prohibited from going up too fast. So there are many reasons that there's no impulsivity to this market right now. It would wreck the world if gold did what it really wants to do. It would.
Yeah. Okay, so I have another. Okay, let's just quickly answer this for me.
Sure.
I think if the Fed cuts and they start an actual cycle, but gold doesn't outperform the stock market because the stock market also rallies, then maybe
Right.
gold is capped at 3,000 because the measured upside target from the cup and handle pattern is
Right.
3,000. So
Is it
that
really?
could be like a logical, it's also a big round number. So that's my
Right.
thinking is maybe 3,000 if the economy holds up, or it looks like at that point it's going to hold up, gold could get to 3,000 without needing to outperform the stock market. So I'm just saying everything that's been happening, maybe this continues up to at least or at most 3,000.
Let me rephrase that. so that we're still talking about the same thing, because I agree with you. The Fed and the government and whoever is interested in capping the gold market has no problem with 3,000 as long as stocks go up too. It's almost like the Fed's looking at commodities going, well, we got oil under control. We got Bitcoin under control. Oh, fine. Let the gold boys have some fun. Silver, no. Nothing else can move. It's like when COVID started, it was lumber, and then it was eggs, and then it was milk, gold, but don't let it go up too fast. We don't want it to get ahead of itself. Meanwhile, you know what? Yeah, you guys want it to go to 3,000? Fine, go to 3,000. As long as stocks are going up, we'll deal with that. That's fine. And when you look at it from a fundamental point of view, it's like if stocks are going up and gold's going up, then that's predicting in some way, shape, or form a hyperinflationary event. I'm not saying it's happening tomorrow, but that is a fear with the deficit that we have. So yeah, I agree with you. Gold can go to 3,000 and they won't give a damn as long as stocks go up as much or more. That's right.
Okay, now, yeah, let's talk about some of the other fundamental reasons why I don't want to say you're outright bearish, why you're leaning towards the bearish side
Okay.
over the
Yeah.
next, is this, what's the time frame of this? Are we talking about a couple months or just like a month?
Well, I'll tell you. Well, there's two time frames. One is the next 2 weeks, and the other is the next 2 months. Okay. So um, um, I have skin in this opinion right now, and I'll explain it in a second. But the next 2 weeks, look, I'm looking at the chart, the same chart you are, and I'm like, there's nothing bearish about this chart. I'm not looking at GDX. I'm not looking at silver. I'm going, there's nothing bearish about this chart. 3 months ago, we would have died for this chart. Wait. It's a monthly high. It's a weekly high. It's almost a daily high. Macro discretionary is going to come in again, I would say to you. How many times have we done that and been right? You're like, it's a monthly high. I'm like, well, macro discretionary is going to come in. Those boys are looking at this. The breakout from the cup and handle, that was a new all-time high, a new monthly close. They're going to buy, and they bought, and they bought, and they bought, and they bought. Can they buy more? Yes. Will they buy more? I don't think so for the next 2 weeks. They'll be back in the next 2 weeks. Now, I don't have a strong opinion on this, but I have an opinion enough to have a position. So to give you the reasons that I'm, let's put it this way, not bullish for the next 2 weeks is number one, from a big picture point of view, and I don't mean super big. I mean, look, these are the bull factors. We know these bull factors. I'm very event oriented right now. The BRICS summit is coming up on October 20th to 22nd. That's bullish. The market knows about this. Maybe Ma and Pa Kettle in the US don't know about it, but Ma and Pa, Vladimir Kettle over in Russia, and they all know about it. They are long. China knows about it. They're long. China's macro funds are long. Everyone over there is long, and some of our macro funds are long. So for me, the BRICS 22 event, which could resolve extremely bullishly based on news, but as the run-up comes, I'm thinking there's a possibility of a backing off and buying. Possibility. Second event, presidential election. Without a doubt, that's going to add $100 to this market. If someone says I protest, that's $100 overnight. Like, it's ridiculous. Like, the election will not be over until the inauguration. That's my opinion. So that's going to cause volatility, and I don't think that's in the market. Some of it's in the market, but not a lot. So those are the known events. There's another known event that happens every year forever, and that's something that I call sell season. And sell season isn't necessarily bearish. It's a time of year when hedge funds start to unwind positions as the year end approaches. Now, if you're a hedge fund and you've got a position on and you have futures, you have to pay your taxes on those futures. It's not like Kamala Harris doesn't have to repeal capital gains taxes on unrealized futures gains because You already have those. You have to close those futures positions out to pay your taxes, some of them. You have to close some out to pay your clients. The end of the year payouts are coming. Maybe you have redemptions. And so between roughly Labor Day and Thanksgiving, every people sell. And they sell because their fiscal year ends in November. A lot of these funds, fiscal years end in November, and they start to unwind. So in the past, that would mean gold goes down because whoever's long sells. Oil goes down because whoever long, it goes down if there's no other news. And there's never been other news in gold. It's always like, what's going on in gold? Ah, the funds are selling it. There's no news because it was gold, it was a pet rock. No one cared about it. So this year, it might not sell off, but there is selling that must come in. That's because people have to pay their taxes. And so between Labor Day and Thanksgiving is sell season. There is organic, not organic. There's mechanical selling that must come in. Is that a lot? I don't know. Is it a little? I don't know. Is it taking profits? Well, this year it's taking profits. That's really good because if they're taking profits, they might not sell as much. You don't have to pay taxes on everything, you know?
And then maybe if they're just taking profits, they'll rebuy on the dip.
Oh, well, that's buy season. You're getting ahead of us. That's why I'm not really bearish. So sell season, I define the parameters. Let's narrow it and let's say between the middle of September and November 1st. So basically between Labor Day and Halloween. We use holidays, American holidays. Labor Day and Halloween, there is mechanical selling. And then, to your point, starting a little bit before Thanksgiving, there's mechanical buying. As you just said, those guys who sell, they sell what they have to pay their taxes, right? And then they buy it back because the new year's starting for them. That's exactly what happens. They buy back after taxes. They see what their numbers are. So that whole explanation, we're entering sell season. So it doesn't have to go down, but there is selling. It's like a producer is selling because he pulls it out of the ground. These people are selling. That's the first reason. So the seasonality is saying that there will be selling. It's running right into the bricks thing. And that has freaked me out. I'm like, how can we go down with all this stuff going on? And sure enough, sideways may be the new down. We may be in the middle of down. This could be down. You know what I mean? All right. The second reason is, well, in the micro, I'm looking at some things on the open interest and commitment of traders, and I'm getting the sense that the market's getting tired. I'm getting the sense that someone is. I'm getting the sense that the macro discretionary funds are running out of fresh money to put in, and that means if they're not buying, they're selling. And I'm worried that if the Fed doesn't cut, or let's put it this way, if the Fed cuts 25 basis points and it's not enough, stocks will drop. Gold will drop a little bit as well. If gold doesn't drop, then forget it. All bets are off, right? So between seasonality, uh, the fact that the Comex did that crazy margin change, that's them trying to keep a lid on it, right? Look, they're not going to stop gold from going up. They are, however, going to hold it underwater like a beach ball. And when they let go, it'll go back up again, but they can't keep it underwater long. So I think for the next 2 weeks, there's a good chance of it going underwater. And as a result, I'm long a very short dated put spread to that effect. And in 2 weeks, if the market's not lower, I'm going to lose money and I'm going to say, you know what? Damn it. The bricks really does matter. Like it really is not discounted in the market and I'll get long again. But that's where I am right now. And this is in the face of everything that you and I are saying. The chart looks wonderful. What's wrong with this chart? There's nothing wrong with it. It makes no sense that I'm bearish, but here I am. I've been wrong before, a lot.
Yeah, me too. Just a follow up to that. Well, let's just assume the Fed cuts 25.
Right?
Um, is there money waiting to buy after the Fed decision? I mean, we know
Yes.
that we know that
Yes.
the market to some degree has probably discounted. In the last couple of months, they know a Fed cut is most likely coming. At one point, people
Right.
were thinking, well, remember the sell off? They're saying, oh, some people are saying the Fed needs to cut right now. Then people were saying 50. I mean, we know that they're going to cut at least 25. So that's my thinking is how much money is there waiting to actually buy
Right.
after the cut? Because I remember, not that it's the same with 2019, but when they did that cut in June or July, do you remember that? I mean, the market, it had that the gold price. I mean, it had a pretty good run into that cut, and I remember thinking, everybody knows they're going to cut. It's probably going to sell off somewhat, and then boom,
Right.
you had that huge breakout move, and then it just kept going. So
Yeah.
that's why yeah, I know I'm turning a 10-second question here into a long commentary, but
Well, in my hands, it'll be
I
a
yeah
long commentary.
yeah
I'll try and
yeah
keep it. I'll try.
how much? I guess you already
Okay.
answered the question, but yeah. Is
No,
there
but put a
money
little.
that's going to buy after the cut, and then how much?
Right. Okay. So that question is a very macro economic question, and the answer is when 2019 happened. That was after the repo screw up. That was fearful money that was waiting for the Fed to cut, and then they piled in. There is to answer your question directly. There is money on the sidelines. There was money on the sidelines waiting to go in, and it went in. There is money on the sidelines, but we don't know if it will go in. So, I mean, that's a facile way of saying the market is ahead of itself. There still is, trillions of dollars on the sidelines that could go in. The money markets are huge. So the question is, has this rally? It's very technical, my answer, right? In terms of thinking. The market has rallied in anticipation of a rate cut. Is the powder no longer available for it to rally, or is that the tip of the iceberg? That's the question that we're asking ourselves. And I think it comes down to having a very good macroeconomic feel. Someone like Michael Hartnett, he said, this is what he said, and his answer is probably the right answer for this question. He said, sell the first rate cut, number one. He said, whatever happens to the market, the first rate cut won't be enough to handle the expectations that are in the market. He goes, the second rate cut, however, might be a buy. That's where he stands. He's like, look, if the first rate cut comes in at 25 or 50 basis points, there are people that have been buying this market for a year waiting for the news to sell. And he says, sell the first rate cut. And I'm not going to argue with him. So I would like to see them cut 25 basis points, a little bit of a personal fantasy. Stocks drop 50, 100 handles in the S&P. Gold drops $20 to $50. And then over the next week, stocks go sideways and gold starts to move higher. And I go, the money coming back into the market isn't buying stocks. It's buying gold. That's the look. Stocks have had a nice run in anticipation of this Fed rate cut. And now the Fed's cut. It's like, well, shit, inflation's coming back. And by the way, that's my play. My play is when the Fed cuts, if the stock market drops and gold follows it, I'm going to watch. And if gold goes lower, as a trader, I'm going to watch. As an investor, I'd be a buyer, right? But as a trader, I'm going to watch. And if I see gold drop with stocks and then turn around and stocks don't turn around, I'm going to be like, yeah, that's the commodity bull market reasserting itself, led by gold. Silver will lag in that case because it'll be viewed as economic. They'll sell it with copper. It's all bullshit, but that's what they're going to do. So my answer to that is I'm taking Hartnett's position because I don't know any better. First rate cut is a sale unless it's 50 basis points, assuming no calamity, right? Second rate cut might be a buy. How long between the first rate cut and the second rate cut? I have no idea. So that's it.
Yeah, and that scenario could make sense because if the Fed, like, let's look at it from the perspective of the stock market.
Right.
If the second cut is going to come immediately, that's not necessarily the best thing for the stock market because you look at all the economic indicators we're likely to have a recession. I mean, there's not going to be a soft land. I mean, maybe it's going to be only a mild recession, but you're looking at all these indicators, it's really going to be impossible to avoid a recession. So if the
Right.
Fed has to cut multiple times and it's a real cycle, that's not good for stocks. It's better for stocks if they don't have to start cutting, actually, because that means the economy's strong, they can handle it. But so if the Fed has to cut multiple times, then for gold, the takeaway for gold then is the economy's probably headed towards recession. Fed is going to have to cut many more times. And so therefore, that's the scenario where gold will do well both in nominal and relative terms, against the stock market.
Well,
That's
that's
my
true.
that's my fundamental, whether it's right or wrong, that would be my fundamental explanation for what you
No,
were saying
that's
previously.
that's true. Just to put a little bit more meat on what Hartnett said, according to him, there's a chart on that, and I'll send it to you so you can put it up for your people afterwards. There is a chart. The stock market is discounting 2 percentage point cuts in succession: 25, 25, 25, 25. So they're discounting 8 25 basis point rate cuts. So if that happens, stocks will go up. Do you think that will happen? It sounds like you don't think it will happen. It doesn't. It sounds like I don't think that will happen either, unless there's a collapse. You know, but it looks like, look, we're interest rates are 5.25, 5.5% right now. The short term interest rate, the stock market is discounting the Fed lowering 2 percentage points by August of next year. Period. Any hiccup in that, and stocks go down. So I think you're right. Um,
But here,
with
let me.
regards to the reset soft landing,
Oh, sorry, I'll let you go ahead because I don't want
no,
to take
with
you off
regards to your
course.
soft landing comment, um, it looked like we were going to have a hard landing, right? Again, I'm parroting Hartnett. I just read his stuff. I just put out a big post on it. It looked like we were going to have a hard landing. The Bank of Japan, however, capitulated, stopped the hard land, stopped their problem. Well, capitulated to their problem, which rescued us from a hard landing. We're going to have either, unless there's another catastrophe, we are on the flight path to a soft landing or a soft recession. So you're saying you think a soft landing is not going to happen because there's a ton of data out there saying that we're in a recession. And you know what? The SOM indicator says we're in a recession. People are interested in the labels, and that's fine. We're in a recession. We're in a recession. I don't care.
Also,
But it's a soft recession.
I mean, I don't like the just political talk, but regardless of who wins, it seems like the economy could get worse after the election because
Yeah,
whoever wins, they will want the economy. Like if Harris wins, the Democrats, that's like a good thing for them because they could say, "Well, let the economy go into recession now, then we can get credit for the recovery." Like there's no advantage for either candidate who wins to try and hold it up. So if Trump wins, he can just say, let the economy go into a recession because it'll be a recovery during my term. And
right.
when we start, I'll just blame
And Kamala
everything.
can blame Biden. Kamala can say, it's like Kamala's a third party candidate. She's already
Yeah,
distancing
yeah,
herself from it. It's like,
yeah.
well,
So
but
that's I don't know if it's right or wrong, but that's just kind of a guess that politically for whoever wins, it's their incentive that the economy is worse when they start.
right. Oh,
It's
yeah.
like, remember, not to say it's the same thing as Reagan, but like, he came in and because I don't remember that, but just reading and following, he was not that popular in the first year or so, because the
No,
economy was still shitty. It went into a recession, but he was smart enough to know it's going to recover and I'm going to get, full credit for that. So I don't know. That's just another, maybe it's, maybe it's wrong, but that's just
no,
another
it's not wrong.
thought
You
because
get to
it's,
blame the
with
last
the
guy.
government, all the government hiring that's going on right now, they're, the left is trying to hold this thing up as long
Right.
as they can. And then if they keep power, they can just, they can let it go and then just try and get credit for the recovery.
Absolutely. Absolutely. There's no doubt about it. Like the influx of government jobs has kept and the cooked job data has kept this market believing that the economy is doing well, and now the emperor is being viewed as naked, and people are saying, "Oh, it's going to be bad." Well, then it could be bad, but it won't be felt until next year. Yeah. So I agree with you. It reminds me, it's a line in a movie. I don't know if it was a movie or someone told me, but the incoming president meets the outgoing president of a country, and he says, "What are these two envelopes?" And he goes, "Well, when you have trouble, when you have a crisis, open the first envelope, and that will tell you how to deal with it. And then when you have a second crisis, open the second envelope." And he has the first crisis, and he opens the first envelope, and it says, "Blame me, the guy who came before him," which is what you're saying. And the second envelope, he opens it. I don't know if he has a crisis or not, but he opens it, and it says, "Start filling out two envelopes. The second crisis, you're fired," basically. So yeah, you're right. I mean, Kamala's going to blame, Kamala's going to not blame, she's going to distance herself from it. And Trump can easily blame. I mean, that's the bottom line. So yeah, I agree.
Yeah, and then so looking at the other, so that's why I kind of think a soft recession. I just think the median scenario is probably soft recession or recession. I
Yeah,
think a soft landing, because also it with all the rate cuts, it takes time for that to really be felt and hit the economy. Because, with these natural cycles, the economy is going into recession, they cut rates, and it's not bullish because it's not going to stop the recession or the market from going down. But
right.
inevitably, as the market goes down, it gets oversold, it's way off, and they've cut rates many times. Then the rates start feeding through and actually making a difference in the economy.
Well,
So I think what you were saying before, not to drone on here, but yeah, I mean, either side could be right, because they could cut till 2% over the next, or they could cut rates 2% over the next 12 months. You could
right,
have a recession, I don't know, maybe it starts, or maybe it's already started, or it starts in
right.
November, December,
Let's assume it's
whatever.
already started.
Yeah.
Let's
And then
assume
it
we'll
ends.
find out that it already started. Yeah,
Yeah. And then the recession ends, next summer, basically, or the end of next spring.
right,
So the market could go down 20% or 23% or whatever. But at that point, the rates will start, they'll have a few more rate cuts, and then the rates will
right,
start helping the economy at
right.
that point.
Well, you know, there's something I've recently been thinking about, and it's not new or earth shattering, but the stock market. I mean, it sounds simple, right? But the stock market is not the economy. You know what I mean? So applying that concept, when they cut rates, it's going to help the stock market. I don't know if it'll help the economy. Like, I mean, really, I mean, people are getting like, here's the point of what you're saying. We go into trying to parallel what you're saying. We go into a recession, call it mild, but we're in a recession, right? We go into a recession. It's known the Fed's cutting rates, stock market goes up. People are still going to get fired. Lower rates are not going to stop people from getting fired for the next 6 months. It's not going to fix I'm not I'm not saying you're wrong, but it's not going to help half of the economy. It's going to help the stock market, and there's still, and that's AI is going. The more money that goes into the economy, the more money goes into AI and AI stocks. And if AI works, you're fired. If AI doesn't work, you're fired.
You're fired anyway.
Right, exactly. So I mean, that's like, that's what's going on. If AI works, every service industry in America that uses people in the mid office will start getting fired, right? If AI doesn't work, every high flying AI stock and bullshit tech company is going to start firing people. Half the country gets fired. AI works, half the country gets fired. AI doesn't work. So lowering rates is going to rescue the stocks, but not the people. Sadly, that's what I'm seeing now. You can't stop what's coming with interest rates. And see, a final point: whoever wins, you're talking about fixing the economy, whoever wins, whether Trump or Harris, if they come in with a mandate, meaning if Trump wins and the Republicans take the House and Senate, if Harris wins, well, that's a mandate. And a mandate means, what does it mean in the first quarter? It means we get to spend more money. So you rescue the economy in the first quarter with money being spent. Stimmy checks, whatever they're going to do, they'll do something, right?
Tax cuts.
So the winner gets to spend money in the first quarter to reward their buddies. And so the economy may do better, but probably not. Yeah.
But
I
I
had
guess,
a, Ken, I'm sorry.
just last thing I say, but either way, it does look like a very good setup for gold.
It does. It does. It does. I mean, look, I mean, I can't imagine I don't care whether it's like I'm bearish for the week, right? Let's say, right? I don't care whether it's overbought or there's too many longs or the RSI's printing 100 or the stochastics are bouncing around at 99 for 3 months. I don't care. You got to be out of your mind to sell gold right now with these events coming in. The only sellers of gold right now are A, funds that are long, and B, I am starting to see producers start to sell a little bit. So maybe they're doing their last quarter hedging, which would also keep a lid on it, but not knock it down any appreciable amount, I hope. Knock on wood.
All right. Do we cover everything? Is there another chart that you have or something else you want to mention?
Oh yeah, that chart. Yeah, I had the chart was about my bear case, and I do want to. I want to bring this up. If I could show, can I show this?
Yes, go ahead.
Because it's not about the bear case. It's an angle that we haven't discussed, but I think it would add a little bit of value to your audience. So let me find that. No, not a portion of the screen. Uh, oh, there it is. All right, here we go. You see a picture there, right?
Yes.
I'll make it a little bit bigger. All right, check this out. The red rect, this is part of the work that I do for Goldfix on Sunday Conversation. So I did an early take on it. The red rectangle represents the 5 days covered by the Commitment of Traders report. The red rectangle on the right represents those days. Now, I want you to focus on the red rectangle on the left and we can go through, I'm not going to go through every day here, but go through the last day. See this last day here? What's that, a hammer or a hanging man?
That is a bullish hammer, but it's not bullish when it comes after a move up. Like it's a reversal candle, but it's supposed to be at a bottom, not a top.
All right. Okay, got it. Right.
And the fact that you see it at a top, that's a sign that the market is kind of losing strength.
Well, there you go. That's the technical take on what I'm about to say, right? Technicals come from somewhere, and to have two different disciplines corroborate each other. All right, check this out. In the gold market, not every market, but in the gold market, when it's behaving normally, when the candle is green, the open interest goes up. When the candle is red, the open interest goes down. To put a little more meat on it, when the candle is green, that's speculative funds that are bullish buying. When the candle is red, that's speculative funds that are already long puking. There aren't a lot of short-sighted players in gold, okay? Especially right now. Like I said, you'd be out of your mind to be short gold or selling it short for any length of time right now. So the normal behavior is red means long speculative funds are puking. Green means long speculative funds are buying. Short funds are pretty much non-existent. Now we go to your candle. What's that, like a hammer in the wrong spot? Like
it's a bullish hammer, but it's really only bullish if it comes at a bottom, not at a top.
This is wonderful. Okay, check this out. This is a green candle. It's supposed to have open interest go up, but it doesn't. It has, if you look on the right, 4114, open interest dropped on an up day, which means, without a doubt, that on this day, shorts covered. That's a short covering rally that looks like a hammer or a hanging hammer, whatever it's really called. Now, since if what I'm telling you is true, there are no shorts in this market left to cover, number one. And number two, when shorts do cover, it's usually the sign of the end or near the end of a blow off top.
Yeah, exhaustion.
Exhaustion. That's the word. That's the word, right? I look for the next days after that to be a spike higher and a red candle, kind of like a long wick that creates a genuine hanging man, something like that, or shooting star, whatever, evening star, whatever they call it, right? But we haven't gotten that yet. What we have had is 3 days afterwards that are down, up, down, and that's the battle. And on that last day, what happened? The CME said we're raising margins on gold. And so I think this may end up being the capitulation driving us lower. Now, as I said, we could have that spike higher for a day or two. But I think this, with so few shorts left in the market, except for our beloved bullion banks, that this is a potential sign for exhaustion. And so I'm short. There you go. When you see a green candle, anybody who's a technician, when you see a green candle in gold with open interest coming in, it means something. When you see a red candle in gold with open interest going out, it means something worth looking at as well. And if you have a good technician working with you and he says it's this shape or it's that shape, well, you can see if the idea is corroborated or contradicted. That's why I'm bearish. We're going to open up tomorrow night at 2580 and run to 2750, and this whole conversation is a waste of time, and you'll have to delete it. But that's where I am right now. All right? Thank you for letting me share that. I will stop that.
Wait, yeah, great. I just have one quick follow-up. I'll mention my levels and you could think about your question. Or yeah, my question rather. So my question is, at what level would you get out of your short? Now
Oh,
looking at the technicals, I see strong support on the daily chart, 2400 to 2440.
all right. So you're looking at futures or spot?
Continuous, the futures.
All right, so futures. Let me pull those up. All right. Gold futures. If the market doesn't hold 2485, I'm bearish down to 2400. Okay? Now, in a more short-term oriented thing, by the way, which is my trade is short-term, if you look at the gold market as essentially a ledge, right? You know what? I can share this if you want because I have the futures up now. You want me to do that?
Yes.
Okay, good. Because then you can talk about it as well. Where is that? There it is. All right, so here we are. Let's get rid of that. And there's your gold chart. There's your daily gold chart. And you say 2400 or so.
Yeah, 2400 to 2440
All right.
in that
So
area.
essentially 2400. So there's your zone of concern, right? That makes sense. I'm going to give you some really short-term numbers, and they're just obvious. They're just anybody who understands how to look at a chart is going to say, yeah. You ask me, when am I not bearish anymore? Well, if we get below here, I'm going to get more bearish, but I'm not going to do anything. If we get below here, I'm going to get super bearish down to your level. Now, what makes me not bearish? It's very simple. This whole market right now is a range, right? It's this, it's this range. That's how I look at it. I look at it like this, remove that, clean it up a little bit, remove that, and move this up to, I don't know, let's say here. All right. Above that top line, I am no longer bearish
Yeah,
because
a
then we get
strong
that impulsiveness, right?
yeah, a strong move above 2060. Yeah, then
Yeah, exactly. Right. I mean,
what
look,
we're
look,
talking
for
about
me,
is
it's like
moot.
I'm short, right? If it gets above 20, whatever that price, that's futures, right? So a strong move above 25.60, well, that's going to make me not bearish. If it, however, goes up above 25.60 and then finishes down into that body again, I'm going to say, well, there's your hanging man, there's your evening star, and I'm going to get more, and I'm not going to be bullish yet. But if we get below here, I'm going to mortgage the house, and I'm going to get even more bearish, but only for 2 weeks. So, like you said, capped, well, like I said, capped here and trading. If it gets above here, we're going up. If it gets below here, then it's still going to be bought on a dip, but probably not as aggressively because it's sell season. That's where I am.
Yeah, looking at closing prices, 2430 is 2430 is that's a really good support level.
Closing price. So what is that? Right there?
Yeah, 2430. Yeah.
Well, that's a daily, right? Let's zoom out a little bit. What's it look like on a weekly? Sorry, I have a lot of my own lines in here. Oh, yeah, look at that. See that? That area right there. There's by the
Yeah.
way, that
Yeah.
makes a lot of sense. There's the last channel we had. Capped sideways. If it's capped sideways down to here, but below here, we're back into that zone. And by the way, this is where the macro discretionary guys are probably going to start selling. Yeah, I agree with you. That's good.
All right,
All right,
Vince.
let's call it a day.
Yeah, let's call it a day. Before we sign off here, please tell our audience how they can subscribe to Gold Fix
Yes.
on Substack.
Uh, Goldfix Substack or vblgoldfix.substack. We talk about gold. We talk about silver. We talk about inflation. We talk about macroeconomics, geopolitics, and secular trends. And we analyze reports by banks that are very good reports. And we also do a significant amount of original writing and podcasting daily. You could subscribe there. And you could also register at UConn because I'm teaching in the fall again for corporate finance, which help those kids if they get in class with me. But yeah, so I'm back uh, educating the youngsters again. So there you go. Thank you very much.
All right, everybody, if you want daily coverage of all things precious metals and more, go to Vince Lanci's Gold Fix on Substack, VBL Gold Fix, and subscribe. You won't regret it. On that note, Vince, thanks so much. I think this went a little longer than we hoped,
Of
but
course,
great stuff as always. And I guess we'll talk again in a month.
in a month. See you next month.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.